So is FDI even possible in a limited liability partnership? The answer to that is yes, but it is subject to two conditions. It needs to be based on the FDI policy, which is formulated by the Ministry of Commerce and Industry, or commonly also known as the DIP. So FDI in that particular sector needs to be possible. It needs to be under the automatic route. And the most important factor is that in that particular sector or industry, there should not be any performance linked conditions. So this is where the difference comes in as far as an LLP is concerned. So if there are any conditions attached to that particular sector or industry, then FDI in that LLP would not be possible at all. So just to give you an example, in the IT and the IT enabled services industry, 100% FDI is possible, and there are no performance linked conditions at all. So therefore, FDI in LLP is possible. If you take another sector, let's say for example NBFCs, 100% is possible and under the automatic route as well, but it has certain conditions, which are, for example, you need minimum capitalization norms, etc. So in that case, FDI in LLP would not be possible at all. So you have to evaluate this from your end and see which is the sector or the industry that you belong to. If FDI is allowed in that particular sector, and if there are no performance-linked conditions that are imposed by the government, then obviously you can go ahead and you can incorporate a LLP and receive foreign direct investment in it. So let us speak of an exit right now. Whenever an investor is investing in a company, he's obviously looking at an exit at a future point in time. So what is the most easiest and what is the most simplest way of exiting for an investor from a compliance perspective and also from a tax perspective? Now, when an investor is investing in a company, obviously he pays cash for the shares that he receives in the company. And when he wants to exit, that money cannot be returned back, but those shares have to be taken back by the company. So a very common option which is being used by companies to give an exit to investors is to conduct a share buyback. Now, a share buyback is a very tedious process under the Companies Act, and it requires that in a financial year, a company can only buy back 25% of the outstanding share capital of the shareholders is concerned. So that becomes a problem. You cannot give 100% exit. Furthermore, there are a lot of other compliances to be carried forward from a compliance perspective, and there needs to be a cool-off period of approximately a year, which must have elapsed before you conduct the next share buyback. Plus, there is also a share buyback tax of approximately 20% plus the surcharge that is applicable on the company, which it has to pay on behalf of the investor or the shareholder, and then return the money back. So, from an exit perspective, a company structure is definitely not the most feasible option out there. Now, as far as an LLP is concerned, the procedure is absolutely simple and straightforward. And all you need to do is you can give an exit to the investor who would be a partner in the LLP in a very simplified manner, and there's absolutely no threshold in it at all, and there's absolutely no tax perspective or any tax angle other than the taxation liability that would be applicable on the investor, which would be the case in any such scenario. So from an exit perspective, again, LLP has great advantages over a company. So when it comes to reporting, there is no difference between a company or a LLP structure because both of them have to follow the same guidelines as have been laid down by the RBI. You have to file a form with the RBI after you have received money into the bank account of the LLP or the company with the authorized dealer, and you have to give prior intimations and you have to keep them informed. So as far as the reporting is concerned, there's absolutely no difference. As far as the compliance and the annual filing requirements are concerned, there is a huge difference between the two. So as far as a company is concerned, you have to conduct quarterly board meetings, you have to get your books audited mandatorily, you have to maintain a register of members, you have to pass an AGM every year on the due date, and then as and when required, as and when the company needs to conduct any business or it needs to take any key decision, then you have to file an EGM. And not only this, that after you conduct all of these meetings, and the required necessary things that you need to do at your end, you have to file the requisite forms with the registrar of companies. So there is a lot of work that you need to do from a compliance perspective as far as a company is concerned. Now, as far as an LLP is concerned, this is where things are very simple. They're not complicated at all. The procedure is absolutely streamlined. All you need to do is you need to file 2 forms on a yearly basis with the registrar of companies. So that is form number 11, which gives the annual return of the LLP, and then there is a form number 8, which gives the financial statements of the LLP at the end of every financial year. So from a compliance perspective, an LLP has a great advantage over a company. So you will have to evaluate all the pros and cons of incorporating either a company or an LLP, and thereafter accepting foreign direct investment. You'll have to see the advantages and the disadvantages in both the scenarios, balance it out, and see what works for you. My suggestion would be that if you are operating in a sector or an industry where FDI is allowed in an LLP, and if you're a small setup with not a lot of investors, and you're obviously at that stage where you're just about in the process of raising a seed round, which is again not a big amount, then obviously I think you can stick with the LLP structure, because there are a lot of other advantages that would follow from an exit perspective, from a taxation perspective, and also from a compliance perspective. But if you are an entity which has grown, you have a multiple set of investors. If you need to give different rights to different set of investors, which again comes into the picture quite often, then you would probably evaluate a company structure. Well, even in that case, a lot of people go down that route, even though there are more compliances to be conducted, and it is not very friendly or very advantageous from a taxation perspective. But it's all about what you want to do and how you want to go about doing it. Obviously, an investor also plays a key role in this, and taking his views into consideration are equally important. But I think the ultimate decision would rest with you. So if it's a small setup, I would say go in for an LLP structure. If you have already outgrown, if you have a lot of revenues, you have a lot of employees, and you have a lot of investors, then you could probably stick with the company structure.